Hello, here is another session to cover up transactions of journals. Typical uses of journal. Journal is one of the book of prime entry, and what are its typical uses? Some of the main uses of journal are listed below. It must not be thought that this is complete list because there are multiple other uses which are not mentioned here. So the number one, the purchase and sale of fixed assets on credit. If any asset or any sales are to be recorded on credit, will be recorded in journals. Writing off bad debts. So here is a new term, so we must be clear with the meaning of bad debts. Bad debts means all the debtors of the business, all accounts receivables who are supposed to pay to the business, if in case due to certain reasons they are unable to pay their amount to the business. So business is will be facing a loss because of these debtors. So those losses, the amount which is not recoverable from the debtors, from the credit customers, that will be recorded as bad debts because that is a loss to the business. It will be recorded as bad debts. Then if there is any recording of bad debt, that will be recorded in journals. The correction of errors in the ledger accounts. If there is some mistake, there is some error that is found later and that is to be corrected, that will be recorded in journal. Opening entries, these are the entries needed to open a new set of books. So all types of opening entries will be recorded in journals. Adjustment to any of entries in the ledger. If there is any adjustment required later, there is any kind of account receivables, payables, any kind of entries which are accruals, prepayments, receipts, those will be recorded in adjustments. So all type of accruals, outstanding expenses incomes, all prepaid expenses incomes will be recorded in as adjustments in journals. So here is the layout of journal. The journal, date column, details, folio, debit, credit, along with currency signs. The name of the account to be debited on the debit, the name of the account to be credited on the credit, then a simple narrative will be written there along with the amounts. Yes, here is an example of compound entry that is recorded in the journal. Like we can see the narration that tells us what is going on in this transaction. Assets and liabilities at the date entered to open the books. As we had discussed, there is one basic use of a journal, that is to record opening entries. So here are all the opening entries of all assets and liabilities which is recorded in journal. So we can see all these accounts are debit. 1, 2, 3, 4, 5, 6, 7. All these 7 accounts are debit and 2 accounts are credit. So these all are assets and these 2 are liabilities. So assets are recorded on the debit side and liabilities are recorded on the credit side. And there is another one, capital, that is also credit. So assets and liabilities at this date, which date? 2016 July 1st. So assets and liabilities at this date enter to open the books. Van, fixture, inventory, accounts receivable, B. Young, D. Blake, bank, cash, all these are assets with the business at start of their session. So then there comes their liabilities. Accounts payables, M. Quinn, C. Walters and capital. So all these 3 are liabilities which are written on the credit side. So we can recall our concept of accounting equation here. Assets are equal to liabilities plus capital. So liabilities plus capitals here and all assets are there. Their total must be equal on both sides. 10,765, 10,765. There is another page. It shows us journal ledger. As I told you, after journals there will be recording of transactions, posting of those journal entries into ledgers. There are 3 types of ledgers we had just discussed: general ledger, sales ledger, purchases ledger. So general ledger records all types of T accounts other than debtors and creditors. All customers, all accounts receivables are recorded in sales ledger, all accounts payables are recorded in purchases ledger, and rest of all T accounts will be recorded in general ledger. We can see here van, fixture, inventory, their T accounts are kept in general ledger. And these two customers, accounts receivables, credit customers, B Young, T Blake, they are recorded in sales ledger. Same way there will be another purchases ledger that will be recording all suppliers, credit suppliers. Here is another task to do. You are to show the journal entries necessary to record the following items which occurred in 2016. May 1st, bought a motorbike on credit from Lakeside Garage for 5,500. A debt of 347 owing from T reason was written off as a bad debt, that is to be recorded. Office chair bought by us for 600 were returned to supplier UL Furniture Limited as they were unsuitable. Full allowance will be given to us. So that is a returns entry. Next, we are owed 300 by J-Day. He is declared bankrupt and we received 190 in full settlement of the debt. Next entry, we take goods costing 60 out of business inventory without paying for them. Some time ago, we paid an insurance bill thinking that it was all in the respect of the business. We now discover that 40 of the amount paid was in fact insurance of our private house. So like it was drawings, but it was recorded as a business expense. Bought a trailer for 1,700 on credit from Sealand Limited. So these are some transactions which are to be recorded in journals. If we look at the first transaction, bought a motorbike on credit from Lakeside for 5,500. So it is a purchase of motorbike against 5,500. It is credit transaction. So we can see how it will be recorded. Motorbike account will be debit and Lakeside credit. A debt of 347 owing from T reason was written off as bad debt. Bad debt is expense for the business because accounts receivable is asset. When it's not recoverable, that will be recorded as an expense, bad debt. So bad debt is expense, and which debtor is to be reduced? T reason. T reason was accounts receivable debit. Now it is to be reduced as T reason credit. So we can see it here this way. Bad debt expense debit and T reason is credit with 347. Next entry, office chair bought by us 600 were returned to supplier as those were unsuitable. So this is return outwards, how it will be recorded. UL Furniture Limited 600 and office chairs credit as return 600. It's not recorded as return outwards because this is asset. So assets are always to be recorded with the name. So office chairs is credit and the supplier is debit because that liability is reduced by 600. Next transaction, we are owed 300 J by J-Day. He declared bankrupt and there is 190 coverage and remaining 110 is the bad debt. So it is to be recorded. 300 was supposed to be received and out of 300 only 190 has been received. Bank has received only 190. Bank debit 190 and J-Day has paid 190 out of 300. So 300 is the total amount to be received. Only 190 is received. So remaining 110 is lost to the business as bad debt. Bad debt 110 and J-Day is to be reduced with 110. Next entry, we take goods costing 60 out of the business inventory without paying for them. So it will be considered as drawings. Drawings debit 60 and purchases 60 credit because purchases stock is to be reduced. Purchases are credited with 60 and drawings expenses increased with 60. Next entry, again it's a drawing entry because it was considered as a business expense but actually it was a personal expense. So insurance, personal insurance is charged as business insurance, so that expense is to be reduced as credit. So insurance is credit 40 and expense of drawings is debited with 40. Next entry, bought a trailer 1700 on credit. It's asset, trailer debit, and land credit. Trailer debit and electronic time limited 1700 is credit. So those were some more examples of journal entries and their recording in journals. And there we see a quick recap of capital and revenue assets, capital and revenue, incomes and expenditures. Capital expenditure, all big expenses which are long lasting, their benefit is for long term, and all minor expenses where benefit remains for the short term, that is revenue expense. So here are some more examples. Depreciation on machinery, cost of labor, rent paid, all these are revenue expenditures. And funds which are paid by the company to acquire, upgrade, and maintain physical assets such as property, plants, building, technology, those are capital expenditures. And as there are capital expenditures and incomes, there are capital receipts and incomes as well. So all those incomes which are of huge amount, they are with the benefit for a long-term benefit for the business, like some asset has been sold, that is capital receipt. If a routine expense, if a routine income has been received, like rent received, commission received, interest received, that is day-to-day routine income, that will be recorded as receipt. That will be recorded as revenue receipt. So here, on the basis of the today's discussions and previous discussions, assignment is to be completed, and thank you so much for attending today's lecture and listening this video. Thank you so much.